Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news to the U.S. and global economies and how investors are modeling out the impact of the coronavirus. Phil, it's great to have you with us. Thanks so much for joining us on Trade Talks. And now we're starting to actually look at some valuations with U.S. stocks as we are in the thick of earnings season.
Yeah, well and truly in the thick of earnings season. And it's interesting because we've been watching the analysts downgrade their expectations ahead of the earnings season and as the actual numbers have come out. And a lot of companies have shown that they've increased provisions or they've had revenue cuts that were pretty significant. And I guess for the most part expected, although also remember that's just Q1. So Q2 is going to be worse. But what's interesting in the left-hand chart here is just looking at the valuation. So once we saw the market rally back up, while at the same time seeing earnings being cut, you've actually seen the forward price earnings ratio get back to levels that are even richer than before we started the coronavirus sell-off. And I think that's got a lot of people talking about whether equity market valuations are stretched. I mean, obviously, forward earnings are fairly uncertain, and that's something that we'll talk about in the next chart, is just looking at how many companies aren't even giving guidance going forward because they can't tell how long we're going to be under lockdown, what that's going to do to revenues, how things are going to be when we get started back up, and how quickly spending is going to recover. So we don't really know whether the earnings cuts are going to last 3 months or 12 months, but the forward PEs that are coming through the consensus data is actually pretty rich right now. So that doesn't help equities alone.
Yeah, and if we take a look at that second chart, I think the two things that we really have to watch, of course, are interest rates and what fiscal stimulus is going to do, if it's going to be inflationary or not, because for analysts, it has to be tough. I mean, how can you properly value stocks when it's not really based on earnings or revenue, but money from the Federal Reserve and the Treasury?
Yeah, I think interest rates are one of the factors that definitely support such strong valuations. And if you look at historic times of high PEs, it's when interest rates are low. And we've obviously got near record low, 10-year out interest rates right now. So the discount factor that you would use to discount forward earnings is actually pretty low, which helps those earnings and the recovery add to the stock's valuations. But when we think about interest rates, there's a couple of things to keep in mind. One is the fact that when we've got so much fiscal expansion, that money flow and the creation of money could actually create inflation itself. And when inflation goes up, typically interest rates go up as well. And the other thing that you've got to worry about is whether we will just get higher interest rates because we have so much government debt. And so if we have too much government debt, then maybe people start to price in some credit risk of defaulting on debt, whether it's America or other countries in the world, where we see these negative and very low interest rates start to go up just because of market forces and people not willing to keep financing the level of deficit. And what that's going to do for governments is make it even harder to afford to pay the interest on the debt. So there's a lot of different factors that are going to be complicated for economists and for the governments to manage 4 or 5 years out from here.
All right, let's take a look at U.S. COVID-19 data. It doesn't seem to be as if it's improving ex-New York, New Jersey, and it's starting to impact newly affected states.
Yeah, this is a super interesting chart, isn't it? Because when we've been looking recently at the US cases, we've been talking about how we're kind of stuck at 30,000 new cases per day. That's where we were a month ago, and it's basically where we are right now. So this chart was interesting because it strips New York and New Jersey out and looks at the rest of America. And you can see that the New York and New Jersey area, which was under lockdown relatively early, and actually Seattle was too, even though it's included in the blue line, have had a pretty good success at tackling corona and getting the caseload of the new cases down to 50% of peaks. The rest of America is actually still seeing a growth in cases. And that's why when you combine it all together, the US doesn't look like it's really tackled the problem very well at all.
All right, and to wrap up here on positive news, as always, it seems as if spending is finally picking up in some areas.
Yeah, when we look at some of the states, I mean, Georgia obviously opened up relatively early, and there's signs that the spending has already picked up in Georgia. There's quite a few areas where you can see people are getting back to spending and getting back to going to shops, and it's helping the economy recover a little. This is airlines and people passing through TSA security and security globally. And it's still incredibly low, below 8% of normal levels, but it's started to climb. And so I guess we can see light at the end of the tunnel. when we can start to see that trajectory start, improving. The only thing we've got to make sure of now is that we look for better testing, hopefully vaccines, and we don't see a second wave of cases as we slowly open up.
All right, Phil, great to have you with us as always. Thanks so much for joining me.
You're welcome, Jill.
All right, and I'm Jill Malandrino, Global Markets Reporter at Nasdaq.